In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon, Market Rebels from a very windy and rainy and somewhat chilly South Florida. Stu, how is it up your way?
Bright and sunny, man. 90 degrees. I'm ready to roll.
Why don't I believe that?
Yeah, well, it's kind of cold. How about that?
Cold. All right, well, good stuff. But at least it's not snowing here, and but we do have some very cool information for you. We've been getting a lot of questions about this in our Q&A, so it's kind of what spurred this thought. Before we get there, quick reminder: Virtual Pass. Check that out, Stu. Click that with your camera, the QR code, and you can get a nice discount for the Virtual Pass. Stu and I will be there for 2 hours on Thursday, 2 hours on Friday, doing live interactions and really just showing a lot of myths and misperceptions that retail traders have. And we're going to show you the difference between that versus professional traders. Going to be a lot of fun.
A lot of class interaction, and yeah, it's going to be a lot of
It's going
fun.
to be a lot of fun. So click that little code right there or take a screenshot of it for later. But we'd love to have you join us live. And if not, next best thing right there. So today, what's our topic? Do LEAPS options give you more opportunities?
Big topic these days.
Big topic. We've been getting that a lot. People asking about LEAPS. And the one thing that we want to, before we even start, is to just tell people, excuse me, it's a time frame. There's nothing really special about the fact that we call it a LEAPS options. I'll talk about that in just a little bit. But before we even get started, it's just a matter of time. So that should tell you right there, if everything's priced according to fair value, at least theoretically, the word leaps isn't somehow giving you an advantage. So
or a disadvantage for that matter.
or a disadvantage, right?
It goes both. It's just it's a what do you call it, Bill? An acronym? It's an acronym, right?
That would be an acronym.
Long-term equity anticipation security. That's it.
We're going to talk about that. So here's our Chalk Talk question for everyone. Does a 1-year call give you 12 times the opportunity for gains as a 1-month call? That's kind of like the way it's been phrased in a lot of our Q&As, isn't it? People think that I'm getting all of this extra time as if that's going to give them a big advantage for profits. But once again, that's overlooking the bigger picture of finance. If it has a bigger chance for profits, what do you know comes with it?
Well, that's where I was going, man. Like, why wouldn't they give you a bigger chance for the loss as well?
And all that is true too, but they would also give you a bigger price tag, right?
Well, of course, time is money.
Exactly.
Kind of
So
across
that's
all
all.
industry, right?
That should be something where people should say, "Hang on a second. It can't be for free. It's never for free. And if you can at least tap the brakes and think about that, it'll save you a lot of headaches." So let's dive in a little bit more and find out what's going on here. Another little pause. Marketrebellion.com/get started. More great information just like this. Lots of articles and videos, all free. I don't even think you sign in for it. You just bang, lands them right on the page. But it's super important to get a good foundation before you start trading options because there's a lot of bad information out there.
No,
I'm not kidding. There is.
I don't believe that for a
I
second.
know. Yeah, who would think? So let's start off with LEAPS options. What are these things? Well, as Stu said, they are long-term equity anticipation. That's where the AP comes from, securities. Now, I have to tell you, I had nothing to do with the making of this acronym. I think it's absolutely horrible. I think they tried way too hard to make it something with leaping into the future or whatever, but that's how it came up. But the thing
Well,
is that options were viewed as short-term speculating trading tools. So they were like 9 months and below. And when they were first started, we had just quarterly expirations, and they had the current month and the following month plus two of the remaining quarterlies. And then finally, as they gained some traction, they got lots and lots of shorter term things. But I think it was probably more of a marketing deal. They thought, well, they don't just have to be for short term speculation. So going to longer dates seemed contradictory. And they just thought, well, how are we going to cross that hurdle? So it was really more of a branding idea. This is actually a trademarked copy of the SIBO. It's like Nike or some. It's just a brand name that they gave it. Now, it has nothing to do with the options pricing formula. You're not getting uh, better advantages. You do get cheaper units of time, but that comes at a cost as well. But
it's like saying, well, the 6 month one is better than the 3 month one, but the nine
if
month one is better than the 6 month one, but the 12 month one is better than the 9 month one. Doesn't
right,
work like that.
if that were true, it'd be an arbitrage,
Yeah,
right?
we
That
would
you
buy
can't
the
say
9 month one and
you
sell the six
exactly
month one.
right, right. So it can't be true. So even if you just understand
Which, by the way, side note here, sidebar, we do that, but we don't do it because of the time. We do it because of the discrepancy in implied volatility.
very good.
That's what
Yep,
trading is.
correct. Yeah, it's a subtle hint, but you can see why people mistake it. So I was trying to think of ways to make an analogy out of this. I thought it might be a little bit like Toyota creating Lexus, right? They wanted to come up with this higher end, compete with the, I don't know, maybe the BMW markets and stuff like that, but it would be very hard to do with the Toyota name. Not that it's a bad name, but it doesn't have that same elite status. So how do you get over that? Well, you create a different umbrella for it. And that's really what they did with LEAPS. They just said, oh, the reputation we have is short term, speculative, dangerous stuff like this. Nobody's going to do it from an investing standpoint. So that's the first thing to understand is a little bit of the history. It
And
has
that was
nothing.
really successful
Oh, it was big.
in the automotive world. I mean, you have what do you have? You have Acura, Honda, and Acura,
Yeah, yeah, that's right. A lot of them do
right?
that. Yep.
Nissan, and I think it's Xfinity. I always get those confused.
Yeah.
Infinity,
Infinity. Right.
the stock, the cable thing. Yeah, and of course you have Toyota and Lexus. So yeah,
Yep. So that's kind of the history of it. But now, what's the bigger issue behind here? What is it that we're after? Don't get hung up in the acronyms or that I'm getting cheaper units of time and therefore I've got an edge and I've got a better chance to double all these other crazy things that people come up with. Let's go back to our little lattice work. Now, this is actually a pictorial version of what's called a binomial option pricing model. We could actually go through the same thing and say we know out here what the expiration values would be, right? Those are easy. It's either intrinsic value or zero. And then we just keep discounting it back all the way to the start. And it's, again, it's another way to come up with a theoretical option price. And if we made these time spacings small enough, we would get exactly the Black-Scholes formula. Who would have guessed? So it's just another way to kind of understand option pricing. But I like to do it without making it too complicated with the numbers. Let's just look at it as flipping a coin. So we've got different paths. This flipping a coin 5 times. Here's our first, this column right here, heads, tails. Here's our second flip. We could get heads, 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 tails, heads, or tails, tails. But it's right there. There's our third, there's our fourth, and there's our fifth. So let's say that we're trying to do some type of a payout, some type of a gamble where you're going to maybe make $1 for each head. Well, that would be a $5 payout. And this is exactly what they do with the options in the binomial pricing. They're saying, okay, if the stock is up here at 120 and this is the 100 call, we know that that's worth 20. And then there's a little trick that they have to do to come back and back it in to figure out what this price would be. But if we hit this path, we're one off. We've got 4 heads. Here we've got 3, we've got 2, 1, and down here is 0 heads, which is the same as saying we got all tails. But if we count the number of paths, look at that. We have only one way to hit 5 heads. That's going 1, 2, 3, 4, 5. We have one way to hit 1, 2, 3, 4, 5 tails or 0 heads, but it's symmetrical. And this is really a bell curve on its side. If we were to turn it by, it's another way to understand the bell curve. We can derive that from this as well. But when we talk about a path, what we're saying is, for instance, this is one path. And that's why we got 3 heads. Okay, we got 1 head, 2 head, got a tail. There's a 3rd head, and then we ended up with a tail. So that would have a payoff of $3. But there's 10 different paths to get there. So this is what we call the weight or the probability. You can already see there's 32 ways, 32 possibilities, right? That's just 2 times 2 times 2, 5 times, or 2 to the 5th. So this whole column adds up to 32. But look at this, 20, 30 out of 32 ways are right here. 20 out of 32 ways are right here in the dead center. So we have a lot of weight. In other words, most of the time, where you're going to end up? Somewhere in the center. It's very odd, very hard, if it's truly random, to just continually march up here or to march down here. It does happen, but it's rare. Okay, so that's kind of the shortened version of our lattice thing to work with here. Now let's do it with 10 heads. Or for 10 flips, but we're playing for maybe 10 heads as our payoff up here, 0 down here. Same game, but look what happened to our lattice. Look at all the numbers in here. Now you can see that this is similar to going out in time. Let's say the first one maybe was 5 months and this is 10 months, or 5 weeks and 10 weeks. It would be a way of thinking of it. So even though people think, oh, I've got double the time, I can make way, way, way more money. Sort of. Yes, you might be able to hit 10 instead of 5, but what are the chances? There's 1,024 possibilities. See, that's the part that they forget. What we call the density has really gotten thick here. So I like to call this our tree. The branches have gotten super, super thick in here. And that's the part that traders overlook. As you go out in time, you are increasing the probability. You've got so much more density in here. Far more likely you're still going to just end up where you probably would have, even though you've got the chance to come way up here at the expense of way down here. And that's what you brought up too, Stu, right? You go out in time, yes, you have the chance for bigger payouts, but you can also fall further.
Yeah. And
So
and depending on the depending on the tilt of the implied vol out in time,
yep,
um, you may very well wind up paying more for the pieces of time
absolutely.
on those out of the money options.
Yep. And
Right?
that's something that
It's
people
like
overlook.
the inverse. You know, you hear all the time, well, you know, buy time or cheap it per segment of time.
Right.
If I
Maybe.
buy if I buy 12 months, you know, it's better than buying 1 month 12 times. That holds true for those at the money pieces. But when you start going out of the money,
And that's true too.
it could flip. It might be about the same or close to it. But if you start getting what's called an up tilt, where the out month volatility, which has much higher vega than the front month,
Yep.
you might wind up paying significantly much more per that segment of time. That is something you absolutely have to take a look at.
And that's what we're going to show in Miami, that the professional traders look at the quote board. That's where the action is. We want to see what the pricing is. And if you look at what the retail traders do, they say, oh, let's see if we can predict where the stock is going. And then who cares what you have to pay for it? The option's 3. Well, I don't like that price. Let's come down here to 1. Who says that 1's a great deal? 1 could be a horrible deal. They have no idea that that's where the game is played, is on the quote board, not in trying to predict where it's going. We have to say, what price are we paying for this? But now there's something else to consider here. Let's say if we are, maybe our thought or our hope is that we're going to get 10 heads. Or maybe we don't even know, but we're just marching along and all of a sudden we end up with 5 heads. Here's the part that starts to throw people, is that especially with like out of the money leaps, they go, okay, I've got lots of time and I'm getting close. I'm starting to get really close. My odds must be improving. But what they don't realize here is that at this point, if you were flipping this coin 10 times, if you end up with 5 heads in a row, 31 out of 32 of those branches just got nixed. They're gone. So all it tells you, it doesn't tell you that you're close. It tells you that you're on a very, very small, fragile branch that is probably going to fail at some point. Now, again, some people say, well, hold on a second. I only need 5 heads, and that's 1 in 32. True, but you also have to say, what did it take to get here? This wasn't for free. This was also 1 in 32. And so if we say, what's the probability of getting this, given that we've already got 5 heads, it's 1 in 32 times 1 in 32, which is 1 in 1,024. See, it doesn't change the overall probabilities. That's where it can be a little tricky looking at these conditionals, where people think that they're getting closer, but they don't realize that they're on such a small, fragile branch. And this, again, is what happens when people buy, let's say, LEAPS options, especially if they're not super far. Maybe they're right on the cusp at 10 months or 11 months. And they say, oh, I've got a LEAPS option. Well, okay, barely. But for some reason, because they say the word LEAPS, they think suddenly it's a bond, and it just is
Yeah,
going to
it's
make
kind of a mystique, that's out there that
right.
is 98% of the time, misquoted, misgiven.
Misquoted, right? So that they'll see this and they'll go, well, because it's a LEAPS, let me go out and go something super far out of the money. And as we talked about today in Q&A, do not ever mistake the fact that an out of the money option is an out of the money option, and it's low probability, period. We talked about that too, where an at the money option has about a 34% chance to be profitable, not to go in the money. That's about 50-50, but to be profitable about 34%. That's for at the money. That means we have to beat
Stinks. Is that why I should sell options? Because they all go out worthless?
Another misperception. Exactly. No, that is not it at all. But you can see where people fall into that.
So you just look, everyone, you got to be careful about what it is that you're doing. That's what we try and do here. Here's an example. I'm looking at a stock, had a really nice move today. It's in the financial space. I'm not going to name the stock, doesn't really matter. But this is what happens all the time. You have a 6-month out of the money option, pretty far out of the money, 50, 200, 25% out of the money.
That's good.
Straight about $1.50. Okay. If I go double the time and I go a year out, it's close to 5. So let's just kind of think about this for a second. If I paid $1.50 for a 6-month option, and 6 months from now I kind of do it again, that's $3. But if I buy the 1 year out, same strike price option, which does have a different delta, I'm not going to argue that. I'm going to pay close to 5, and that's more money than 3. So is it really cheaper, or is it actually more expensive? And what are you really buying when you buy the time? See, that Bill and I, again, we say this all the time. We are not here to say, yes, you should do this, or no, you shouldn't.
Right.
We are here to educate the public about what it is that you're buying and selling, and what it represents, and where the pitfalls are, and where the benefits might be. And then it's up to you, the trader, to make a decision, to weigh the pros and cons. There's always going to be benefits, and there's always going to be pros and cons. There's always a trade-off. Say this one works for me, I'm good. And then you go for it. Oh, is that what that is? That's where that hole is? Nah, let me do something else. And you find the strategy that works for you.
Yep. So now let's take another look. If we remember these numbers here, 110, 45, 120, 252 in the middle, there is a thing I think most people are familiar with called Pascal's triangle. Probably had that in elementary school at some point. It's a very neat, created by Blaise Pascal, or the, at least he's credited with it. I think there's other people who had done it before. But at any rate, it's a kind of a neat little algorithm. You start with 1, and then we're going to assume whenever you have a 1 that there's zeros out to either side. So we take its neighbor, 0 plus 1, gives us the number below. And up here, 1 plus 0 gives us 1. This number is derived from 1 plus 0 is 1. This 2 is derived from the 2 up on top. 1 plus 1 is 2. 1 plus 0 is 1. And we keep going. And you can see that when we had 5 flips, those are the numbers right there. 1, 5, 10, 10, 5, 1. When we do 10, that's right here. There it is. There's the 252. There's the 2 10s. So one thing that we can look at this is that, let's just say this is a 5-month option. And you look and you go, but if I go out to 10 months, I've got twice as much time. And I might be able to get 10 instead of 5. These are all the things that attract people to LEAPS. But take a look at what happens. Can you hit 10? Yeah. But this number right here is only 10 out of 1,024. It's probably not going to happen. But instead, look at how dense it's gotten in here. I mean, if you just add up these, what is that? 252, 420, 492? 492, almost half of your 1,024 is just in those 3 cells. So as you're kind of meandering through here, like if we turn this sideways, it would be kind of like our coin flipping game, that you're probably going to just stay here in the center. You're most likely going to be just staying here doing what you probably were going to do, but you're just paying more for it. So yes, you do have the ability to get out here, but don't mistake that those probabilities are shrinking. Or at least I shouldn't say shrinking, but they're small. You shouldn't think, oh, I've got an out of the money option with 10 months to go, and because it's a LEAPS, therefore it's got a good chance. That is not true. And that the main thing is that stocks do not move in a straight line. See, a lot of these cancel. That's why we end up with all of these different possibilities. Think about it. There's 70 ways. Doesn't look like it starting from up here. But there's 70 ways to get to that cell. So we could do this and down here and just trace a path. There's one way, right? We could come down here and over this way, and then here, there's a second way. There's 70 of those paths. Kind of hard to see. And that's because a lot of them cancel. And that's really the heart of the idea of square root pricing. As a stock is drifting through time, it doesn't go in a straight line, right? It wiggles and it goes up and down. And it's called a diffusion process. And that's why a lot of those ups and downs tend to cancel. If a stock goes up 10 points and down 10 points, didn't go anywhere. And so that's, again, this is where a lot of people get into trouble by thinking that they've got some kind of an edge by doing LEAPS. Now, again, we're not saying they're bad. We're saying you just got to be careful of what it is you're doing. Now, here's another example. We're going to be doing this in Miami. I think it's a great visual. Instead of talking about a bell curve and standard deviations and variance and stuff like that, let's look at something we can see. Okay, so on a roulette wheel for the US, we have 38 spaces. That's like our bell curve. The probability is 1 that we're going to land somewhere in here. So let's say that we place a chip on a single number that pays off 35 to 1, and we go, let me go out in time. And therefore I have more probability. Well, what just happened? Oh, if we come here, that's really what's called a corner bet. In Vegas, you would actually place your chip right there on the intersection. But mathematically, it's the same thing as placing those chips on each of the individual numbers. So do you have a better chance of winning here? Yeah, 4 times as much. What did Vegas do to the odds? Cut you by a fourth. It's got exactly the same payoff. There's no edge. Even though you're going, hey, I got a better probability at this. The point is, it's all accounted for in the Black-Scholes model. And that's why what Stu said, if there's something we trade, it's not because we think that we have some kind of an edge with just the probabilities. It's just simply the fact that there's a discrepancy in the pricing somewhere. So this is a really good way to show, what if you want to cover the board? That's fine. You're still going to pay the 5 1/4 edge. You got a tremendous probability of winning it.
Yeah. I was going to say, but you're going to win 100% of the
You're
time.
going to win 100% of the time, but you're going to pay for it. That's the part that people don't see. So if you're going out to LEAPS, we could extend this and say, well, what if you wanted to cover all of these down here? I got
Wait a
a
minute.
much better
Time
chance
out.
of winning.
Time out.
100% true, but you're also going to pay for it.
Are you saying that if I win 100% of the time, I could walk away a loser?
In Vegas, you will. Yep, you can cover that board. And
How about if I win 100% of the time in the options world? Can I walk away a loser?
It'd be hard to win 100% of the time.
Let's just say I did.
What do you mean by win?
Well, not win. So let's say I won 99% of the time.
Right, you could still end up losing.
You could still wind up losing.
You could still end up losing that deal. In fact, you could lose it bad. Because the 99, let's say out of 100 times, maybe you pick up 10 or 20 cents, picking up nickels in front of steamrollers, right? And the one time you lost was on a massive naked put position that you got docked for $1 million.
Yeah, you sold upstart 350 puts when the stock was 400. And that term that we use fairly often, nickels in front of bulldozers, that's a relative term as well, guys.
Sure.
It doesn't necessarily mean picking up a quarter.
Nope. It could be 10. It could be $10.
Yeah, right. I mean, if you're looking at a chance of winning,
or it's $1,000 stock with a tremendous amount of volatility, you say, but I could make $10 on this put. But relatively speaking, that's peanuts. It's nothing.
Yeah,
compared to
you
what
make you make $2 on it or $1. I mean, it kind of feels good.
Yeah.
But are you really pushing things to make some real money?
If you have a high win rate, here's another little nugget. A high win rate means what? That there's potential devastation waiting. It just means that you've compressed all of that probability somewhere else, because in the model, it has to all balance. You're not going to win all of that for free. So that tells you that it's a matter of time. And this is where traders say, but I'm watching it closely, right? So anyway, let's take a look at some other things here before we do. Quick reminder, marketrebellion.com/get started. So to really show the difference, I don't really like to show math, but sometimes you just have to, because it is math. Otherwise, we're arguing over what we think we see versus what's actually happening. So take a look at this, a Black-Scholes pricing model. And to make things easier, I've knocked out interest rates and dividends. I have $100 stock. We're going to keep that the same. Exercise price is the same. I'm going to change days to expiration. I'm going to keep volatility at 25. So we have the options price is about 286. What does that mean? If you bought this option thousands of times, no commissions, or if you sold it thousands of times, no commissions, you would just break even. That should be a clue right there. It doesn't matter that you think, oh, it could double or it could do. Of course it could. But you're expected to break even. And after commissions, it's expected to really be a loss. Let that be a lesson, everybody who wants to do lots and lots and lots of short-term trades. But now the question is, what about the relative pricing? And one way we can do it, we can say, let's look at how big the options price is, 2.859, divided by the stock price. Okay, how big is that premium? But we have to scale it for volatility. If this were a 1-year option, we would just divide by 0.25. But because volatility is priced according to the square root of time, this is 30 out of 360 days, square root of 30 over 360. We multiply those together, we divide them into that, and we get 0.3962. All right, so we would say that's the relative price of this call. Are we going to do better if we go out in time? That's what people will tell you. Well, let's go check. We make it a 1-year option. Ooh, Black-Scholes now says it's 988. We got cheaper units of time. Everything's good. We got a higher probability to move further. But not necessarily true. Once we understand that options trade in information time, we see a different picture. 988 divided by the stock price of 100 divided by volatility. Of course, square root of 1 is 1, but I just put that in there to keep the formula the same. And look at this. Kind of seems like the same number again, 0.3952.
Bill, Bill did not scale what he used before because the volatility of 25 is an annual number.
That's correct.
So he didn't have to scale it.
Yeah, I could have just left this off, but I didn't want people to get confused. But if it's a 1-year option, you don't have to scale it. So now what if we go to a 2-year option? Now this is a LEAPS. What if we go to a 2-year option? And by the way, if you trade the SPX, they have super LEAPS that go out 5 years.
5 years.
So now we go, okay, am I getting a better deal? Right? If you want to make the argument that you've got a better chance of getting $110, $20, $30 or doubling your money, fine, make the argument. But don't ever forget that the probability has to stay the same and you're paying for it. All you're doing is you're taking that bell curve, instead of making it tall and skinny, you're squashing it down, and it's got to go somewhere. So you're just kind of spreading it out over time. So watch what happens here if we go to a 2-year. $100 stock, same. Oh, look at that, it's 14 bucks. Right? We should scale by the square root of 2, or 1.41. We know it's going to be about a $14 option. And then, what do you suppose this is, Stu? 14.032 divided by the stock price of 100 divided by the volatility. But now we have to take the square root of 2 because it's 2 years. And look at this, 0.3969. It keeps cropping up.
What was the price of the other one? What was the price of the 1 year? 80?
I'm sorry?
What was the price of the 1 year option? The theoretical value price? Yeah, 980.
988. Okay. So Black-Scholes seem to have this thing cornered. And that's one of the beautiful things about the model. It is arbitrage free. So that's another way to say you shouldn't have an advantage just because you're trading a LEAPS option. In fact, it could be a disadvantage depending on pricing. But now, we've talked about this before. Where is this roughly 0.4 number coming from? Anybody remember that? If we look at our bell curve, right there, it's the peak. Okay, so for an at-the-money option, that's where it's going to be priced. So that's, once you see how it all fits together, and listen, I know it can be a little tricky to see that, but you can also understand why it can be real easy to step into a trap when people say, oh, look at this, you're getting cheaper units of time. You have more time, the stock is going to march like a straight line up to this, and we're going to make all kinds of money because it's a LEAPS. Not true in the least, at all. There are different reasons for using LEAPS, but right now we just wanted to kind of dispel that myth. Just because it's a LEAPS does not mean a single thing. In fact, Stu, back when you were trading, long before they even had LEAPS, you had the ability to price them. You just never had the need to, but you had pricing models, right? You'd say, what's a 1 year, what's 2 year, what's a 5 year? If they came out with 10-year options right now, they could price them immediately tomorrow morning. That's not the time isn't the problem. So for all of the new traders out there, get away from this idea. We've been getting this question a lot from people about LEAPS, and I want to learn LEAPS as if it's some type of a separate strategy. It's just a name.
There's this thing. There's this thing called a flex option. You know, they used to come into the crowd every now and then.
Oh yeah, of course, yeah, do flex.
Right, a broker would say, we want a market in a listed option that is not listed. It's right. Listed, but we want the strike price to be, 106.32. Well, we don't have 106.
And we want 37 days to go.
And we want 37 days or 537 days.
Right.
And we want 10 o'clock versus 3 o'clock PM expert. All these like crazy things. And
how hard was that to price?
And they give a market, right? So how do you get something like that? I mean, you can't look at your neighbor and say, "Oh,
Right.
well, what do you make in the
Where's it
market?"
trading
And
at?
or how about this? Let me call up my market maker friend and see what his market is. See, it doesn't really work like that. It's a model. You plug in an implied volatility, you plug in all the other inputs, days to expiration, strike price, blah blah blah. Out pops the price. Make a bid under it, make an offer over it, and there you go. You're off to the races.
Yeah. So again, for anybody who's new, we just thought that would be really helpful. Again, we want to be very clear. We're not saying that leaps are bad. We use them a lot. They're the ones we've made the most money in, but they're for different reasons why we're using them. And that's one of the things we want to show people in Miami. Or if you want to get your virtual pass, you will be able to see the entire presentation. So let's go ahead and answer our Chalk Talk. Do leaps provide an advantage? I'm sorry, this is not Chalk Talk. It's another recap. So if priced fairly, no. 12 months, we would have to say you're not getting 12 times the benefit. We would say you're getting the square root of 12, which is about 3.5 times. So now think if you're going from 3 months to 9 months just because it might, or 10 months because it might technically be a leap, you're getting very little benefit. But this doesn't mean it's 3.5 times the profit or the ability to profit. What it means is you have 3.5 times the amount of diffusion, that drift, think of that little coin, that tree branching out. That's the diffusion process. It goes by a square root of 2. You're getting 3.5 times that by going out 12 times the amount of time.
And don't forget, if you have an upside tilt, you're really taking it on the chin.
Exactly. Yep. So something like this, a basic idea is that they create more of a stock-like exposure without having to maybe roll every single month. But we've talked about that before. Outside of commissions, if you just rolled them, there's really theoretically no difference in them. So this is a way to get, especially for
On that
those
high delta, on that
on the
high
high
delta,
delta, right?
maintaining that high delta, which you may not, it may not happen either, right? That high delta, look, 100 shares of stock is 100 shares of stock, no matter what the price of the stock is. But
Yep.
100 deltas in an option may turn out to be 10 deltas in an option down the road.
It could. We've seen that happen.
Yes, we
But this
have.
is a way to say I would like stock-like exposure without the gamma or the theta or the vega. But again, there's a lot of missing pieces in here. We talked about turning over cups and revealing information. People think, oh, I don't have the theta. Again, that's true, but it's a little bit of an illusion. The reason you don't have the theta is they're not revealing information quickly. Right? Think about this. If you have an at the money option, exactly dead at the money, and there's a half a day to go and the stock ticks up $1 or $2, what happens to that?
Nothing.
Man, but no, it's in the money now with 2 days to go. Yeah, it goes. It's going to be delta
On the short term one. I thought you were
on the
asking
short term one, right? So it's massive. Why? Because you
Yeah, it might go
reveal
from like 5 deltas to 90 deltas,
on just
just like that.
a 10 or 50 cent move or something, right?
Think about expiration. Think about like
1
going
cent.
2 minutes into expiration.
Yeah.
You have a dime out of the money option that might have a no delta or 5 delta,
Yep.
and then 10 seconds later when the bell is ringing and it's
Delta
10
1.
cents in the money, and all of a sudden it's 100 delta. Hey man, that's a lot of gamma.
Yeah. Now, take that same idea and put it out 2 years. And you're going, man, my friend Stu just said his stock went up like $2, went up an infinite amount of percentages, and my leaps over here didn't do anything. Why? Because that tree is so big. We've got so many cups to turn over. It just didn't really reveal a lot of information. It's like maybe kicking a field goal, score 0-0 in the first quarter. Crowd doesn't really flinch over that. It doesn't reveal a lot of information. Compare that to if they do it with this maybe 21 all late in the fourth quarter. Now that 3-point kick can greatly swing the odds. And it's the same thing here. So when you're playing those leaps, understand that they are revealing information, but because they reveal information slowly, that's also why they decay slowly. So it ultimately comes down, you get what you pay for. And so anyway, I think that's
That's a good way to put it. You get what you pay for. There you go.
Yep. So remember, if it created an edge, it would create an arbitrage. That's always something to fall back on. If somebody tells you this is better, it can't be. It would be an arb, and trust me, it would be arbed out quickly. So our Chalk Talk, does a 1-year call give you 12 times the opportunity for gains as a 1-month call? It's the way a lot of people think of it. No, what you could do is say it gives you 3.5 times the amount of diffusion. And whether that's good or not depends on how you're stacking up your strategies, but that's a conversation for a different day. But for right now, I think that's probably a good stopping point. We hope that that gives you some things to think about. Once again, please join us in Miami if you can. And if not, check that QR code and get a virtual pass, and we're going to have a phenomenal time. We're going to go into a lot of depth about these topics right here. So with that, we will see you next Thursday for Coach's Corner. We'll see you then.